All right, let's do zero DT options.
How did we get here? How did I get here?
You should see my refrigerator in college. That was a crime scene. that was a literal crime scene.
I think you get a mulligan in college for doing that because I think everybody's is kind of. I'm sure yours was to the next level, but I'm sure
it was a crime scene.
Yeah.
Zero DT options. Daily butterflies. Let's do it. So, a lot of people have been asking about. I've been trading daily butterflies. I started out in the SPY. I switched it to SPX about a week ago. So far, every single day they've worked out. I've been doing them the day before or day of. Doesn't matter. Usually one DT, but sometimes zero. And just doing them. I've been doing them $25 and $30 wide. They've been trading between yesterday was 3.5, but mostly between $4.50 and $5. Just fooling around with them, staying small.
So it's funny what you just say. What you're trying to say right there is you even in a relatively small amount of time, you're watching how volatility affects. Which we just did a piece on a moment ago. How it affects even something like a butterfly because the strategy widens out or contracts the closer you get to expiration, and you're doing them with 1 day to go.
Yeah, and I did the SPYs too. At first, they were like around 40.
Tiny.
Well, I was just trying stuff out. They were around 40 cents, so about 1/10 the size of SPX. So if SPX is $4, the SPY is about 40 cents. The only problem with
that's
the SPY,
how 1/10 works. It's you put it as
the only
zero.
problem with the SPYs is that they settle to stocks. So the ones that settle to cash are easier. But you know what? At the end of the day, I haven't held a single one to the end of the day anyway, so I don't care.
Right, so it wouldn't matter
in
in those examples. That's
so.
Correct.
Today we're going to look at a popular strategy that's been employed by zero DT option traders called butterflies.
But to go back, if you buy a butterfly in SPY for 40 cents and you sell it at 60 cents, it's the same proportional profit as $4 versus $6.
Yeah, of course. But
it's hard to take 20-cent profit on something. But go ahead. Yeah.
What I kind of want to say is that since we've been doing the show, we haven't even spent a half hour of time in the last 10 years on butterflies.
No,
because they're really not a.
When you're doing something for 45 days out and closing it at 21 days, a butterfly, no matter where the stock goes, isn't going to work for or against you.
Yeah, so we don't usually talk about it much because 45 days out, they don't move at all. So, but with zero DTs, so they're tradable. That's all. The only difference. And somebody emailed me this morning. They said, "Why do you do those?" And I'm like, well, you know what? I don't really have to watch them. It's like I know what my risk is. I don't have to do anything. So,
and from a buying power standpoint, $70 some odd $1,000 for a ratio spread in SPX. In a 0-day option, that's not. It's out of reach for a lot of people.
Right. So the reason butterflies have been one of the most traded strategies is because the low cost feature of butterflies remains the same, but the outcome is now every day as opposed to week, month, quarter, whatever. So trading zero DT butterflies allows you to play the expected range of the market every day. That's all it is. It's just a range-bound play. And I've been skewing them ever so slightly to the upside every day. But, let's go to the next slide. So SPX, we observed prices of zero DT options. This is a study. We observed price of zero DT call butterflies with the at-the-money body, $30 wide wings across the following daily expected moves in the S. Less than $25, between $25 and $50, and greater than $50. What is the daily move expectation here?
In SPX for 0 day? Let me give it to you right now. You're looking at 30, it depends on which one you want. You want the 17th that expire tomorrow, or you want the
tomorrow.
57.
57. Okay, so that's a little longer than 1 day. That's almost 2 days. But and what's the daily today?
40.
Okay. So we'd be in the middle category here, between 25 and 50 right now. That's where we are. So we compared the probabilities of AM intraday payoff as a percent of the debit paid. So of 25, 50, and 100%. And then we measured the efficiency of probabilities depending on the expected move of the day. Remember, our expected move is in between 25 and 50 right now. So let's go to the next slide. Okay. And here's where we get into the guts of today's discussion. So on days with a larger expected move, the butterfly will be cheaper, right? Mm-hmm. Makes sense. You have a bigger expected move.
That means the range, you're trying to get in a range, right? With the
you're going to
body
pay
of the
less for a butterfly.
Right.
The higher the volatility, the cheaper the butterfly. That's why this has been interesting right now. If we were in a really low IV environment and there was none of the crap going on that's going on in today's world, we'd probably be in a situation where butterflies would be like double the price of what they are now.
Yep.
So because the probability of moving outside the wing is higher, and therefore the pop is lower and the max profit is higher. Okay. So we're looking at SPX at the money, call butterfly, $30 wide. And here, if the move is less than, if the move is, and this is taking a lot of data, like volatility is so high right now, it's actually even cheaper. But what these guys did here for research wise was they said, if the expected move is less than $25, now remember, that's a really low volatility. Mm-hmm. Then the price of butterfly is going to be $9.50, $30 wide. If it's between 25 and 50, okay, it's $7.25. Can you tell me what it is right now? $30 wide.
At the money, $30 wide? Sure.
At the money, $30 wide.
Sure. So you got 70. You want my body to be at the money, right?
Yes.
Okay. So you're looking at.
I bet you it's about 6 something right here.
Hold on one second.
Because we're very close to like a $50 move.
Hold on one second. $5 right now. I'm doing 39.40, 70, even. $5.
39.40, 70 even. $5. Okay.
Yeah, $5. $5 is the mid price.
Okay.
Yep.
I thought it would be a little bit more. I thought it would be like around $6, but still, whatever. Okay.
Well, you've got about 45 minutes that's gone by too, so you have a little bit of time there.
Okay. Mm-hmm. And then obviously the greater than 50 would even be less than that right now. So the delta out of the money wing is 20, 25, and 33, and the pop by expiration, you can see there.
No. The expected move is 57. Oh, I went to the 1 day. The expected move is 57. It says $5. It's trading right there.
No, I said the same day.
Oh, same day. Sorry.
That's
well,
why
I went to the 1 day.
Oh, okay.
Talking about so it's spot on. So I'll give you this.
I'm saying about the 1 day, the zero DTE.
680.
680, and they said 725.
Yeah.
Okay.
Now, actually, the markets are a little wide. The natural bid is 6, the natural off is 8, so it's close to 7, 710, something like that.
Okay, then they said 725, which is exactly where we are.
Yep.
And then 1 day,
and that's between 25 and 50, and the expected move is a little bit greater too.
Yep. So this is spot on.
Yep.
And which means that the pop by expiration, which is this afternoon, is about a 50-50 shot. Mm-hmm. That's all that means.
Yep.
Okay, let's go to the next slide. So because the butterflies utilize long and short options on a short duration, the probability of making a certain percentage intraday stays the same regardless of the expected move of the day. Now, this is the most interesting takeaway. So it doesn't matter what you do. It's the probability of making X as a percent of the debit paid is going to be the same. All the numbers are exactly the same. This is what we call efficient market pricing. Mm-hmm. So they're exactly the same across the board. So basically, what the takeaway is that it's a decision you have to make about a strategy you'd like to use, but and you just have to recognize kind of, how much risk you want to take, but the chances of making X are virtually the same, no matter what you do, no matter what, everything's priced the same every single day. Like they don't adjust the prices. That's all it is. Every single day you can take the same shot if you want to, it's the same odds. So it's just a question of getting filled at the price that you want to get filled at, that it makes the trade interesting enough for you. Right? Because just look, all these numbers are exactly the same. Let's go to the next slide, which is exactly what we would argue under any circumstance. The key difference on a day where the expected move is lower is a higher initial debit, right? So when volatility is lower, you pay more for the butterfly, $9.50 as opposed to $7, let's say. This does not result in more or less drag, but rather a lower max profit potential because the market's supposed to move less. However, and by the way, how often is that right? 70% of the time. So, however, the probability of seeing smaller intraday scalps remains absolutely the same. Like this is so when I sit here and go, I scalped that today for whatever, it's the same chance every single day. As you know, as long as you pay fair value, it's the same chance of scalping whatever you want to scalp every single day. But you're going to
pay more on entry or pay less on entry depending on what implied volatility is.
That's right. And therefore, you could, if you held.
So you know what the problem is? You know what you're going to see? People are going to come out and go, "Oh, look at this strategy today." This is how they'll sell it to you. We looked at it yesterday; it was $5. Today, it's $6.50, and they'll say, "Oh, it's overvalued." The market makers are overvaluing it. No, it's just that volatility's expanded or contracted.
Yeah, nobody knows. Like you could say. I can understand there's certain products in the world where you probably say, "Oh my God, this could be manipulated, this or that."
Usually, when it's illiquid, when you've got something that's got,
right. But there is nobody can manipulate the S&P 500, so it's never going to happen.
Nobody but Sosnoff back in the day. You big
let's go to the next slide. Takeaways: scalping intraday butterflies allows for a hyper efficient way to play intraday expected moves without tail risk or premium drag that you see on naked options. See, remember, the problem with naked options is that if you're long them, they just go down.
And they're very hard to hold too, right?
This one you can hold for a better profit target. That's why I like it.
Yep.
Setting profit targets, and this is the key here. Setting profit targets of 25 to 50% of the debit paid will result in a pop of over 50%. Of course, it has to, because if you hold to the final close at the end of the day, it's 50%. So if you close earlier, it has to be higher than 50%, especially if you're 25 to 50. So that's what I like about it. So it's that profit target. So if I buy something for $4, I'm looking to make $1 to $2. So I'm looking to sell it at 5 or 6.
That's good.
Yeah, the one we bought yesterday afternoon, we bought for $3.60. We sold this morning for $5.10. That's $1.50. That's right in the middle here, 37.5%.
And then again, you're talking about managing winners no matter what the time frame of the trade is.
Yep.
And matter of fact, we looked at that trade yesterday after you took your profit an hour or two later, and it was a $2 or $3 loser.
That was yesterday's position. Yep.
We'll take a quick 90-second break. We'll come back. You know who we got next? Mr. Scott Sheridan, followed by Jeff Joseph, Luckbox Magazine. We'll be back in 90 seconds.